Welcome to this ACCA video. If you are studying SBR at Strategic Professional, this video is aimed at you. My name is Tom Clendon and I'm an experienced lecturer in preparing students for their ACCA examinations. This video will debrief question number 1 from the first ever SBR exam in September 2018. There are other videos in the series debriefing the rest of the examination. In the debriefs, I will be analysing the requirements and showing you how to apply your knowledge effectively. I'll also look at some answer plans and consider some alternative answers. In debriefing this question, I'm assuming you have attempted the question and have the examination to hand. Question number 1 of the September SBR exam was a compulsory question. And indeed, all questions at SBR are compulsory. But we should be looking first of all at the requirement. The requirement of the question is for 30 marks. But the requirement is broken down into 3 parts, A, B, and C. Let's first of all just consider A. And A is about drafting an explanatory note. And it's about how goodwill should have been calculated. It's about equity accounting, and it's about how the gain or loss should have been dealt with. So what we've got here is a bank of 16 marks on group accounts. But the main requirement has been to draft. Now, if I look specifically in respect of A Part 1, A Part 1 is concentrating on one company and is concentrating on the company of Grape. We are being asked for Grape how goodwill should have been calculated. So this means that I know that the goodwill has been calculated incorrectly. So when I read the information, I'm looking for the things that have gone wrong. Secondly, it's asking me to show the accounting entry. The accounting entry necessary to correct the director's error. When we look at the marking guide, when we reflect back on this question, the vast majority of the marks are going to be for the explanatory issues, for the explaining to the directors why goodwill has been calculated incorrectly. Let's have a look at the body of the question. Let's see where these errors are. When I've read this question, the first thing that struck me was the fact that the fair value adjustment was not included in the 70 million calculation of the net assets of Grape. So we've got, I guess, a couple of marks here to explain that when you're calculating goodwill, that the net assets have to be at fair value. Otherwise we get the wrong figure for goodwill. I mean, what's happening to the goodwill figure here? If we think about the adjustment, what we're wanting to do is to increase the net assets by 5. So we're debiting our land by the additional 5. And this means in a group context, if you just as a consolidation adjustment increased the figure for the net assets, you are therefore reducing the goodwill figure as a result. Fair value adjustment on the net assets at the date of acquisition were incorrect. The second thing to pick up on is that the finance director did not take into account the contingent cash since it was probable it was not going to be paid. Now, when the parent company is thinking about recording the investment in the sub, it must be at fair value, at the fair value of the consideration you're going to give. So when you've got a earn-out clause, we've got to consider the fair value of that contingent consideration. It doesn't matter whether or not it's going to be paid, what the probability is. We've got to assess the fair value. And the fair value in this case can be the expected value. So the fair value will be the 25% of the 16, which is therefore 4. And this is an unrecorded liability. It means that the investment is wrong. It means that there's an additional 4 appearing on that investment. So for consolidation purposes, we've got to recognize that there's an additional liability of 4, and that if you are increasing the investment, you are effectively increasing the goodwill arising. The third error revolves around the measurement of the NCI. The NCI has been measured using the proportional method, and yet we should be measuring NCI at the fair value. Now we're given the share price, and therefore we should be able to calculate the correct figure for the fair value of the NCI. Now I know this is a confusing area because there are two different ways of measuring NCI, but if you've got a policy of measuring it at fair value, then we should measure it at fair value. To measure the NCI at fair value, we need to know the share price of $4.25. The NCI itself is 20% of the 20 million shares that there are, and each share is worth $4.25. So the NCI itself should be in the books at 17. So this means that there is an additional NCI that is appearing of 3. This additional NCI, means that the NCI will go up by 3. If you're boosting the NCI, this will have the impact of creating more goodwill. The requirement of A Part 1 was all about how goodwill should have been calculated and showing the accounting entries. Perfectly acceptable to show the accounting entries as a plus-minus approach or a journal approach. It's the impact on the goodwill that matters. Let's now have a look at A Part 2. A Part 2 of the question is asking us about strawberry. And indeed also, I noticed that A Part 3 is also looking at strawberry. And we're being asked to explain why equity accounting was appropriate. So take that at face value, equity accounting is appropriate. We've got to explain why that's the case. We've also got to show the carrying amount. So there's 2 or 3 marks for explaining why equity accounting is appropriate, and then there'll be another mark or so for dealing with the carrying amount just prior to the disposal. Now looking at A Part 3 straight away, it's about how the gain or loss should have been recorded and how the investment should be accounted for after the part disposal. So this is all about strawberry. Let's go and read and pick up the key facts in the body of the question about strawberry. I'm being asked why strawberry should be equity accounted. That's the correct treatment. And when I read that we've got a 40% interest, when I read that we have the right to appoint 1 of 5 directors, then I'm thinking that we do have significant influence, as evidenced by the 40%, as evidenced by the participation. The second thing I was asked for was to calculate the carrying value of that investment. Now we bought the investment for 18, and we would then be titled to take our share of the post-acquisition profits. Now at the date of the disposal, the net assets were 50, but at the date of acquisition, the net assets were 44. So therefore, the post-acquisition good news has been 6. And we are entitled to add on to our 18 the 40% of the 6, which is 2.4, and therefore the carrying value is 20.4 on the date of the disposal. Part 3 wants us to explain how the gain or loss on the disposal of strawberry should have been accounted for, and how the investment should be accounted for after the part disposal. There's no need to make the corrections. We're explaining how the gain or loss should have been recorded, and we're showing how the investment should be recorded after the part disposal. We see in the question that Banana has disposed of 75% of its 40% investment. Now, I find that a little bit clumsy. It means that we're selling 30%. It means that we're selling 30%. Or to put it another way, our 40%, we're selling 30%, and therefore we're left with 10%. And the question is wanting us to know explain how we would then account for that remaining 10%. Well, when you appreciate that you lose your right to appoint a director and that you've now only got 10%, your significant influence is lost. It's no longer an associate. We have to de-recognize the associate. Now, how much money have we received from this process? We are selling the investment for 19 million. So we can bring in the 19 million, we can de-recognize all of the associate, and then we have to bring back in the remaining 10%. Let me show you that in a simple, quick calculation. In calculating the gain to the group on the disposal of an associate, I'm looking to match the money that comes in with what the group is losing. Now, the proceeds that come in are 19, and what we're losing is the carrying value of our associate at 20.4. Now, in a group context, if this was a sub, you'd be de-recognizing the net assets, you'd be de-recognizing the goodwill and the NCI. But equity accounting, it's all about one line. Now, this is not the complete answer because it's not a match. The proceeds represent 30% of the investment, and yet we're comparing it with de-recognizing the whole of the associate. There is still the residual holding that we then have to bring in. So we will bring in the residual 10% before determining the gain to the group that will arise. And at the date of disposal, the residual at fair value is 4.5. So this will give us the gain to the group that will be recognized in the P&L of 3.1. This residual 10%, what they want to have it at is fair value through OCI, and they're perfectly entitled to do that, given that they've no longer got influence because they've no longer got a director. What they would need to do is to make an irrevocable election to that effect. And the fact that at the end of the year, the investment has fallen means that any subsequent loss, I think it was 0.5, would end up appearing in other comprehensive income and therefore also in reserves directly in equity. Question 1, Part B. Discuss whether the directors are correct to treat Mellon as a financial asset acquisition and whether the IASB's proposed amendments to the definition of a business would revise your conclusion. So this is still about group accounts. Are we buying a business? Is it a business combination? Or are we just simply buying a single asset wrapped up in the legal form of shares in a sub? It shows to me that current issues can appear anywhere in the exam, and they're going to be compulsory. Now, before we quickly have a look at the information, this is a question that was apparently done badly by many students in the exam. And maybe by breaking down an answer plan, we can think about how we could gain some of those easier marks. It might be appropriate to start with a definition. It might be appropriate to start with an explanation as to what is a business combination. We've then got to apply the facts of the case, the facts of Mellon, to that definition in order to come up with some conclusion. And then finally, we should be saying something about the exposure draft. Let's have a quick look at what the actual question looked like. So this is the data that you were given about the acquisition of Mellon. Banana has bought all the shares, but just because you've bought all the shares in a company doesn't mean to say it's a business combination. There has to be a business. There has to be an integrated set of activities, inputs, processes capable, of generating an income. And the conclusion that the question made was that it's not a business. Now, I can sort of understand that because there does appear to be no staff. But what I'm comfortable with is that there are activities. The activities are at an early stage. These activities are going to are capable of producing profit in the future, income in the future. What I'd like to do is show you an alternative answer. An answer that is perhaps good enough. I'm not pretending this is worth 7 out of 7, but I am suggesting that this is an answer which is achievable, which would gain good marks in the examination. What it does is it starts with the definition of a business. It then talks about melon. It talks about, it reasons why the directors believe melon is not a business. It argues that research activities are processes. And then it goes on to reach a conclusion, and it's not frightened of disagreeing with the proposition in the question. And the conclusion is that melon should be treated as an acquisition of a business because there are these processes, potential for these processes in place. The final part of the answer deals with the exposure draft and deals with the idea that under the exposure draft, it would be regarded as an acquisition of a single asset if all the value was concentrated into one particular item, as in this case. So it may well be the case that you could argue that the exposure draft, if that became a standard, that in this situation it would be the acquisition of an asset rather than a business combination. I hope you find looking at a different answer useful. I like the examiner's answer. It's very fulsome. It's very educational. Okay, but this is an answer that I'm showing you whereby you could achieve the majority of the marks available rather than get a good education, which is what the examiner's answer is giving you, a good education. Please have a look at the examiner's answer. Question 1 part C, nothing to do with group accounts. It's all about IFRS 9, how it should be applied to the sale of a bond, to the sale of a financial asset, and including calculations. Now, this is a question for 7 marks. And this is a question which polarized performances. Some of you got it. Some of the students who did this question got it. Others really struggled. Now, when I look at a question like this, again, I think of an answer plan. Again, I think of where the marks are going to be earned. Part of the marks are going to be earned with a definition. Yeah, that's a good place to start. When do we de-recognize? When do we de-recognize a financial asset? What is the theory behind that? And the theory behind that is when you no longer have the economic benefits. All right, when you no longer benefit, when you no longer control. Secondly, we're going to have to apply that knowledge. Yeah, we're going to have to apply that knowledge to the case, to the specific scenario that we're being given. And in that application, yeah, we're going to have to discuss, we're going to have to come up with some kind of conclusion as to, what's going on. And last, but by no means least, then there will be some numbers. I hope you realize by now, the majority of the marks are not going to be either for the numbers or for the rote learn definition theory, but the majority of the marks are going to be here for the application and the discussion. Let's have a look at the facts. Yeah, let's have a look at the facts. Let's see what the story is. There are 2 paragraphs relating to the acquisition of the bond. The first paragraph gives you that stable numerical information. It tells us that we've bought the bond. They're 5% bonds, so that's the coupon rate. Bought them at par. We paid 10 million for them. But we're told the effective rate is 7%, and that because we're going to hold these assets for their duration, that it's perfectly correct that we account for them at amortized cost. Now, it's this second paragraph which contains an awful lot of useful information. You see, we sell the bonds for 8 million when they're really worth 10.5. Now that confuses me. I'm not really sure why we would sell something for less than it's worth. What is more, is Banana has the right to rebuy the bonds. So I'm thinking that maybe in truth, we haven't sold the bonds. That maybe in truth, we may still have the economic benefits of the bonds. We're going to buy them back for 8.8. So 2 years later, we buy them back for an extra 800,000. I think this, for me, is looking like we're borrowing the 8 million and then we'll pay back the 8.8 million. And there's further evidence that this is the case because we've got an agreement whereby Banana will compensate the third party for any devaluation of the bond, and the third party is going to pay us additional cash should the bond value rises. We have, as Banana, we still have access to those economic benefits. We have access to the economic. This is not a sale of an asset. This is really the receipt of a loan. And it's unpicking that logic and explaining that logic, the three things going on there. You don't sell things for less than they're worth, really, causes you suspicion. The option to repurchase it, and these compensation agreements that tell us that our judgment is that it's not to be derecognized as an asset. The numbers are a few marks, and the numbers I think are fairly simple. The fact that we've borrowed 8 million means that we have a liability of 8 million, and then there'll be the running of the interest on that, which is to do with the 800,000. I would just like to show you how the numbers would pan out at amortized cost. This is how the asset will continue to be accounted for under amortized cost. Maybe I'm going slightly beyond the requirement of the question in emphasizing this too much, but what you're doing with amortized cost is you are taking through these numbers through to the P&L. This is your income, because remember, it's an asset. So we are recognizing in our profit and loss account, the income at the effective rate of interest. So we're earning 7%. The cash that we receive, which is the nominal value, the 5%, the coupon rate, is all well and good. So we bank that money, but this is then reducing our asset. We're drawing it down from the asset. Of course, the balance that we've got left at the year end, these are the figures that appear in the statement of financial position. So that's often how we lay things out. And you may be familiar with that type of working, particularly when you think about right of use leases, and particularly when you think about financial liabilities. Same principle, only of course with liabilities, the effective rate is a finance cost, increasing the liability, and the coupon rate is the cash repaying the liability. So the presentation of the working looks the same. Thank you for listening and watching. I hope you found this debrief of question number 1 useful. There are other debrief videos available for the rest of the SBR examination, the September 2018 examination. I'd just like to recap really on a couple of key takeaways. First of all, in SBR, group accounts will always be tested through discussion. The majority of the marks are going to be for writing and explaining. So it's very important that we understand the principles involved. Yes, there are some complicated issues around, but we also need to know our basics from FR. They get re-examined at SBR. We need to study the full syllabus. We need to read around. There was a minority of students doing this exam who did not attempt every part of every question, throwing away marks. And presumably the reason that they didn't attempt those questions because of a lack of study, a lack of knowledge. Please make sure you study the full syllabus. It's a compulsory paper. And current issues. As we saw, current issues came up in question 1, but can occur anywhere throughout the paper. There are plenty of additional resources to help you in your studies. The examiner's report, articles on current issues, and I would encourage you to frequently visit accaglobal.com. Thank you very much. Good luck in your SBR studies.